EOH is the largest enterprise applications provider in South Africa and one of the top performing shares on the JSE in recent years. EOH has a strong SAP franchise and also recently partnered with Microsoft to become an enterprise software advisor, one of only 6 companies in South Africa to do so. EOH has a market cap of 3.1 billion rand and a price to earnings ratio of 14. And EOH is interesting, Paul, because we know that it's been on the acquisition path and many say that its growth has mostly been acquisitive as opposed to organic. And this is creating a bit of concern because they're saying it's the smaller version of Dimension Data, you know, the Dimension Data we saw in 2000.
It's a great story, and the CEO, Asha Bobot, has to be praised for being able to deliver it. And it's an interesting story. In other words, this is an industry, as Craig mentioned, which is not doing that fantastically and it's been a bit sloppy and margins have been very mixed and so on and so forth, but they're a secular growth story. So against that rather odd background, they've been able to just grow throughout the whole of the last 5 years, consistently delivering like 25% earnings growth, growing the dividend, doing fantastically. And the thing that you point to is acquisitions. Good companies do acquisitions and you never hear from them again, the companies they buy, because they integrate them well. Yeah. The ones that don't do them well, of course, where the guy's fighting in the newspapers about how bad his deal was, or he's trying to jump ship, or he's trying to leave and go and start a rival company. With these guys, they do acquisitions and a few months later, not a word.
Okay, so Craig, over to you. What is your view on it? I mean, Paul is painting a very positive picture, and again, something that most would view as a bit of a worry, given the fact that they have been embarking on a lot of acquisitions. Paul is saying that because they integrated so well, this is a positive.
I think what was happening is directors were singing that the ratio between acquisitions and organic growth would be 60% organic, 40% acquisitions. More recently, they're now saying, well, strategy going forward is 50-50. And in my analysis, and I said so as some time back, that it looks like the actual growth is coming from acquisitions, more on a 60% as opposed to 40%. And the growth has you know, been significant because they're buying many of these acquisitions with paper on a very low multiple. And obviously that's going to be earnings enhancing. Fair enough, some of the acquisitions have been cash, but also then on a low multiple. So it is concerning, but they have somehow managed to get it right. I say it's concerning on two fronts. The one is, of course, you've got the earnings flowing through, and that earnings growth stimulates the share price and getting higher. But then you also get the balance sheet bolstered by to the tune of 600 million goodwill. And that goodwill, you know, there's very little proprietary rights in there. It's mainly salaries. It's human intellectual capital. That's that goodwill. And so one wonders, well, is that balance sheet a true reflection of the value of the company?
Okay, that's a good point.
Because,
I mean, if I could just throw this to Paul now. Paul, when we actually stop seeing the acquisitions and they start slowing down, and as Craig was alluding to, is accounting for around 6% of the growth, then what happens to earnings? Do they just
well, you know, there's always somebody to buy. And it's true what Craig says with these things, you know, the talent goes down the lift in the evening and you hope it comes back up the lift the following morning. But I would just say that in the world of sizable business out there, the application of technology is becoming more and more critical. So companies, for example, that implement these enterprise-wide ERP solutions like SAP, the big German software systems, that's what you've got to do. So everybody from the big retailers to SaaS to everybody else in between is using this stuff. So you need people like this to help you run it because the skills are not held in terms of the company. And
obviously the Microsoft deal
more and more of this is going to have to be done. So there's definitely a great business opportunity here. The question is, can they continue to deliver on their growth record? Because clearly the share price is anticipating a little bit of that, although I think they're actually not as expensive as they ought to be given how well they've delivered.
Yeah, and I mean, Craig, again, the Microsoft you know, deal putting them in a very favorable position. On that note, sir, hot or not?
Me?
Yes, Craig, you.
Look, I think it's a hot stock, but there are concerns, probably will continue to go for some time to go. But it's a bit like a Jenga, might rise very high and tumble. And I've expressed some of those concerns. PDSG has sold out, directors have sold out. So I'm not personally interested in buying, but there are pros for the company.
Oh, that's a good point.
Look, the CEO, Asha Bobot's got like 8% of the company. It's got a market cap now of 3 billion rand, so he's done well for himself. But I reckon he's going to continue to do well for his shareholders.
Hot or not for you, Paul?
Hot for me.
Hot.
Happy to have it.